Hello, this is Paul Sullivan. Thank you for joining today for the 2014 mid-year update and outlook. In this call, Troy Patton, one of our portfolio managers and president of Archer Investment Corporation, will discuss the first half of 2014, as well as give us an outlook for the rest of 2014. Along with being a portfolio manager, Troy is a CPA and an accredited business valuation expert. I welcome Troy to give us all your thoughts on the year so far.
All right, that's perfect. Thanks, Paul. Okay. Well, again, like Paul said, my name is Troy Patton. I am a CPA, although my CPA license, unlike Paul's, stands for Cut, Paste, and Assemble at this point. I am one of the portfolio managers at the Archer Investment Corporation. As maybe some of you may know, we not only manage many of the investment clients of Paul's, but also several mutual funds as well. With that being said, is what I'd like to do is I'd like to go ahead and jump right into kind of not only where we're at, but talk about the not really hindsight, but maybe going forward what we prognosticate as what's going to happen. And if there's any ever time to toot your horn, it's probably when you're right in the market, because quite frankly, if you can be right more than you're wrong, you're really doing a pretty good job. And so I will point out a couple areas where I think we've been right, and I think we've pretty much called the market correctly over the last several years as to where it's going to be heading, and hopefully we can continue to do that going forward. If anybody does have any questions, like I said, at the end, we will unmute the phones, and you're more than welcome to ask questions. And if you're online, for those of you who are online, you're more than welcome to type things in, and we'll address those as well. Okay? So one of the things that people always ask me is, as we finished yesterday, the market is basically up about 7.1%, right around there. And when I say the market, I'm talking about the S&P 500. The Dow Jones Industrial Average, quite frankly, is only up just shy of actually 2%. So it has not fared quite as well. But the S&P 500 obviously is 500 stocks, and so we'd like to take a look at that, or even beyond that, the Russell 2000 or the total stock market index, so we can see kind of how the market's performing. Obviously, in the first half of 2014, the markets exceeded our expectations, quite frankly. I think if some of you on the call have probably heard us before, we really anticipated positive returns this year because it was very unlikely that we were going to have negative returns. But we were expecting returns of somewhere around the 9% level, maybe even upwards to 10.5% in 2014. And quite frankly, we have our stock fund and some of the others. I mean, the stock fund is already up 9% this year. That's a little beyond our expectations when we expected maybe the entire year 2014 to be up around 9.5%. But if you take a look at the chart that I'm showing now, and it says, where are we today? The dotted line across the middle is reversion to the mean. So quite frankly, we do feel that the market is still somewhat undervalued. There is some argument to be made, growth versus value, but overall the market is still somewhat undervalued, and that's based on the 12 months forward price earnings multiple. That means the expectations of the earnings of the companies going forward. And if you can imagine, I mean, with our gross domestic product on the next slide here dipping in the first quarter, many of the estimates have even come down at this point. Now, one thing I'd like to just point out about our GDP, as the title slide or the title says, has it mattered? I am somewhat worried that our real GDP was negative in the first quarter, because only two other times since about 1950 did it not indicate a recession, and I put arrows on those instances when it did not. So the question is, was the weather really a factor in the first quarter, or was there actually a slowing of demand for certain products? Now, quite frankly, the numbers in manufacturing and the consumer confidence index going forward, frankly, they do appear quite stable and robust. So it does appear that maybe that first quarter was an anomaly. We are seeing quite a bit of tempered growth in the economy at this point, as most of you already know. There's just really not a heck of a lot going on beyond kind of more of a steady as she goes system, whether it be housing starts. Maybe the one area that's probably exceeded those expectations is automobiles manufacturing, but I think that more had to do with the cycle of the fleet of vehicles that are on the road today versus what they were 5 years ago. So this is one of the things that obviously we're a little concerned about in terms of where the market is and where it's headed. But at the same time, I think there's a lot of other positive aspects of the market, which we'll discuss as well. The next slide, advancing of profits, has started to slow. This is actually a chart that I really put a lot of weight into, and is what it does, and it might be a little difficult to see, but the bubbles at the bottom indicate recessions or close to their recessions. And as you can see, typically is what this chart shows is if company A has higher earnings than it did last year, then that's a positive. If their earnings are declining, then that's obviously negative. Again, our average is the dotted line across the middle, and currently our earnings per share in the first quarter of 2014 were less than robust, although earnings still did come in quite favorably, even though GDP was negative, which is really interesting. So, even though this looks like a negative, it doesn't always have to be a negative. I mean, we can still see a slowing of earnings, but yet still see a positive impact in the market. Okay. This is a slide that many of you have probably seen before, because I keep showing it, and actually I pulled it back out again because I really like this slide, because stock ownership is still hovering around 52%, and it's really well below its historical trend of 60% before 2009. So what that tells me is there's still a heck of a lot of money on the sidelines. People just really are not coming back into the market because, quite frankly, they're just a little timid and scared of the 2008-2009 scenario, with the bust of housing. Okay. Again, another slide I always like to show when we're talking about the market, and one of the things I've talked about in the past is, when will we see some expansion in the PE multiple? I mean, as most of you know, we're at historically low levels of interest rates, and it's really interesting to me to see that we have still not seen a vast expansion of the PE multiple. And I think, and actually, it's kind of a little bit ironic because that you would imagine that if interest rates went higher, that the PE multiples would start to expand as we get into a later bull market. But once again, we just haven't seen that yet, because I think interest rates are so low that it is keeping our PE multiples somewhat compressed. Okay, and obviously that translates into the stock. And for those of you who don't know what that is on the right, that is called a Big Mac. And is what I always like to say is, if you bought McDonald's in 1972 and you sold it in 1982, even though profits expanded by 300% in McDonald's, if you'd have bought the stock and held it for that 10 years, you would have actually lost money. It has nothing to do with the earnings power of McDonald's. It has more to do with just what Mr. Market is giving us as a price each day for a stock. Okay. All right. So the question, as always, is, are we bullish? Well, I would tell you that yes, but obviously cautiously, because we anticipated maybe the market being up about 9.5% this year, and quite frankly, we're only about 2% away from that. So one thing that we've seen is the largest companies. So this is the S&P 100, basically the 100 largest companies. Their trailing 12-month earnings per share is at 18.7, and this was as of, I think, June 27th or something like that, at 18.7, as where the market in general, the reversion to the mean is 18. But so it's interesting that the top 100 stocks, which typically tend to be more of your dividend payers, have done obviously really well and maybe have gone a little bit too far, and maybe some of your growth stocks, quite frankly, are not. One thing that continues to make me bullish, however, is the transports, airlines, the railroads. Obviously, the rails are probably doing a little bit better as of late because of the union shutdown at the stockyards, or the I can't even think of the name where they bring the ships in. But there may be the strike, I think, maybe started yesterday. So some of the rails have done obviously better, but typically a downturn in the market is led by a weakness in the transports. And this time, obviously, transports seem to be doing quite well. So as you can see there by the end of the chart, it's really doing pretty well. Okay. Year-over-year sales momentum. Here's the largest 3,000 companies. Just a quick chart. I like to kind of put this in perspective. I look at this, frankly, just about every month and quarter. And so, our mega caps, which is our top 50 stocks in the first quarter of 2014, revenues were up 1.5%. But the bottom 2,000, they were up 7.7%. That's actually still pretty solid. And actually, if you go down and look at the large cap, the top 300, and then up 3.6%, and look at your mid, small, and micro caps, really, I mean, there's a lot of momentum still in this economy. And regardless of your political beliefs, I do feel like somewhat of the stagnation in Washington will help the business economy. Okay. Again, here, this next slide, it might be a little bit too small, maybe for some of you to see. Really, all it is telling us is that the dividend stocks have run maybe a little bit quicker than the growth stocks have, and therefore the growth stocks may remain a bit undervalued compared to some of the others. That's really all that chart is showing. This next slide is obviously something I've talked about in the past again, but I just want to keep reiterating this, that typically when we see 10 to 16 years of negative performance, like we did in the S&P through 2008 and into 2009, it indicates an upcycle of about 20 to 25 years in the stock market. Now, as you can see by the blue line, I mean, nothing is straight up forever, and nothing is straight down forever. I mean, there's ebbs and flows and ups and downs. But I do think that we are in a fairly cyclical bull market, and I anticipate us being there, quite frankly, maybe for the next 15 years or so. Although, albeit the economy is, I think, chugging along, it is chugging along at a bit slower pace than maybe what some of us would like. So, on the other side is there a case for a bear market? And so what I did is I tried to put together kind of a red flags checklist and say, what would be a case for a bear market? Okay. As I showed, the forward multiple was less than 15 times. So I say, if we get to 17 times forward multiple, which would indicate the S&P 500 at about 2050, I'd say, that'd be a case for a bear market. An unsustainable pace of appreciation, domestic outperforming global, the defensives outperforming cyclicals, a treasury rally. Now we had that, so the bond market was telling us that we should have seen a slowdown in the stock market that we didn't get. And then as you can go down and look at the global indicators, we have seen a significant slowing in emerging market growth, although they're still growing. And then obviously there's some domestic indicators there as well. But we are not seeing a stalled housing recovery. We're actually still seeing a fairly decent housing recovery. So I think the case for a bear market is very minor. Now, with that being said, I do want to say this. we are due for a correction in the market. I mean, corrections come about every 18 months of about 10% or more, and we have not seen one in that period of time. The volatility of the market is down about 33% this year, and usually that's about the time when people get complacent. I'm not saying it's not a good time to invest. In fact, frankly, I think if you're investing for the long term, trying to time the market is a bit of a fool's game. It's like going and playing roulette in Atlantic City and putting it on black or red. You are going to be right sometimes, but yet to try to be right twice in a row, obviously the odds are much slimmer. So you might be right getting out at the right time, and you might be right getting in at the right time. But if you're trying to get in and out consistently, you're going to be wrong a few times. So and being wrong one time actually in 5 turns can reduce all your gains and take away on average about 4% of underperformance of the market. Okay, there's a really good study out by Morningstar that has that same information. So. We're still making plenty of widgets. As you can see, global manufacturing is above, it's continuing to expand above that 50 mark. So that's nice. I mean, I still think things are good there. This title here is not necessarily about the market. It says, is the end near? When in 2008, 2009, people deleveraged. They got rid of their debt. They started paying things off. And I do think that was one of the reasons why our stock ownership is much lower today, because people, I think they cashed in and paid their house off and said, hey, I don't want any debt. I don't want anything coming my way that may be negative. So we started to see a little bit of an end to that, where people are starting to sustain the debt levels they have, and if anything, they're starting to creep up a bit. Okay. The next slide, again, just something else I like to take a look at. Our nominal GDP growth typically exceeds the level of short-term interest rates, and it continues to do so. We average about 6.6%, and the 3-month Treasury bill actually averages 4.6%. I mean, if we tell younger people that, they may say, oh, wow, that's amazing. I mean, 4.6%, that's not even a 30-year Treasury. Well, I mean, obviously, over time, right now, it's basically zero. I mean, 3-month Treasuries are zero. The employment picture. It's kind of I saw this cartoon just the other day. It says, this is our son Eddie. He just graduated from school and is entering a void this fall. Basically, going back to live at home. Even though the employment picture is improving, and the participation rate is continuing to decline, there is still some slack in the economy in terms of jobs needed for people that are graduating. Okay. Some of you have probably seen this before in the past. I've updated this, showing our 2013, what we said in the past, where we thought the S&P would be, and I've projected out to 2017 what I believe is the low quartile, which would be your low barrier. If we did see a correction in the market, where could we go to? And then obviously the mid barrier, which I think is a fair price for the S&P 500 by year end. And so, again, I don't put the high barrier in there, so it's very possible that, if we get to the upper quartile, all I'm showing is the first and second quartile, or at the top of the second quartile, what I believe the S&P would be, would run to. And as you can see, if we're just fairly priced, I mean, we can see some decent returns in the market over time, but we are tending to use up some of those returns earlier in the year this year. Okay. All right. So with that being said, that's it. I wanted to keep it about 20 minutes. I think we're just about there. If anybody has any questions, you're more than welcome to raise your hand. If you're on the phone, which it looks like there are, if you put *2, you can raise your hand, and I'll unmute your phone, and I'm more than happy to answer any questions that you may have there. And it looks like actually there's quite a few online now, so let me see if there's any questions online. If you're online, it looks like there's about maybe 10 to 15 people online. Feel free to ask a question. You're more than welcome to type that in. or Paul and his team, if you guys have any questions or want me to follow up on anything I said, I'd be more than happy to. So,
I have a question.
okay.
If you look at the people out there that have retirement plans or IRAs and listen to this call, what action notes would they take away from? What should they do with their investment portfolio between now and the end of the year?
Okay. Yeah, that's a good question. Between now and the end of the year, for those people who have an IRA, whether you're in retirement or not in retirement, my belief in investing has always been slow and steady wins the race. Having a moderate portfolio or a well-balanced portfolio, I think, is the key to success in investing. I always feel like it's a mistake when somebody says, I want to be an all 100% aggressive stocks. I have 10 years. Well, what if that 10-year reign came to end in 2008, 2009? Obviously those people, they may have lost 60 to 70% of their portfolio. We don't want to see that happen. So, the way we manage money and what we typically tell people, in response to Paul's question is having a well-balanced portfolio now, even through the end of the year, even into next year, I think is prudent for us, for everyone. So.
Right. Well-balanced would mean what?
Okay, so well-balanced could mean anywhere from 40% equities to 70% equities, depending on an individual's risk tolerance. Because I hate to paint everyone with the exact same brush, or even up to 75% equities. But I still believe that equities in the short term and long term will outpace the bond market. Because actually somebody asked me this about a month ago. They said, well, should I sell all my stocks and go into bonds for 6 months? Because typically we have, the sell in May, go away, which obviously didn't work so far this year. And I said, well, the problem is if you do that, what kind of bond can you earn? What are you going to earn on a bond for 6 months? 1%? Well, even the sell in May theory doesn't even work for that, because the stock market has still outperformed 1% mark for those 6 months, and even in a midterm election year. So, again, just having a well-balanced portfolio, I think, is the right answer. And again, depending on your risk tolerance for each individual, depends on what percent of equities you maintain.
So they would meet with their financial advisor to figure out what's well-balanced for them.
Yeah, absolutely. Yeah. So for instance, anyone that's on this call, clearly should, I meet with Paul or someone on his team to sit down and make sure that your portfolio is meeting your expectations. Because oftentimes when you sit down with one of your advisors and you say, my expectations for my portfolio is X, and oftentimes if you haven't met with your portfolio for 10 years or 5 years or whatever, or even in the last year, your portfolio may be saying Y instead of X, based on what the expectations should be. And in all reality, that's why Paul and his team, I think are very adept at looking at the portfolios, because not only that, but not only do they have your best interest at heart, but they know your tax situation too. How many times has your financial advisor in the past asked for your tax returns so they could look at the whole picture? Probably very few, if any. So, okay.
Troy, you talked a little bit about the correction that comes from time to time. I was talking to a client who wasn't able to join us today, but he wanted to know, and I think even though you've talked about this, I think a lot of people ask this question. He wants to know, when would you pull out of the market to avoid the correction? And I know you're talking about timing. But
yeah, the answer would be no.
Would you do it today and sit? Yeah.
No, I would not. I still wouldn't. See, I think one of the really neat things in the market that's happened really since 2008, since the downturn, is there is actually less shares available today than there were in 2008 from a supply and demand standpoint. In fact, this quarter was the largest quarter ever in company buybacks and dividends ever. And so what's happening is all these large companies and small companies that are flush with cash. Many of the companies that we invest in, they have no debt. They just have cash on their books and excess cash. So what they're doing with that cash is they're announcing stock buybacks. We've seen large companies announce very large stock buybacks, even companies like Monsanto. And some of them, wanting to buy back 12% of their stock on the open market. And some of them have issued 4% bonds, which leads me to believe that they can earn more on their stock than they can in a 4% bond market. I say that's a positive sign for the market. So although we may have a correction, whether it be with Iraq, although I think that's minor right now, or maybe this union strike in our shipping ports, something like that could offset the market. But quite frankly, I'm surprised that, first quarter GDP being flat to negative didn't offset the market. So, that's what I'm saying. Even for someone like myself who sits here and watches this stuff daily, it just, anyone who lives by a crystal ball ends up chewing glass. Mm-hmm. So, okay. Anybody else?
Troy,
yeah,
I have a question. This is Raj.
Yeah, Raj.
So what kind of advice would you give to people who have a 401k with their employer but have not had it reviewed for a while? Maybe they set it up like 5-10 years ago. They don't know what kind of portfolio it is. So when would be a good time for them to, and who should they go to if they want to get their plan reviewed?
Yeah, great question. Yeah, one of the things that we do oftentimes, and I know Paul's team does as well, is if you have a 401k, bring the statement in. Let us review it. Let us take a look at it, and we'll take a look at that 401k and see if it's see if there's some adjustments that need to be made. Because oftentimes, just over time, even over a 5-year period of time or a 3-year period of time, your portfolio can get out of balance to what you believe. You may believe you're only 70% equities because that's how you were investing over time, but because equities have done so well, you may find yourself at 90 to 95% equities and not even realize it. So I would encourage everyone, and we do it all the time, to get their 401k statements out, get your choices out, bring it into the office, and have someone on Paul's team take a look at it. And obviously, we'll help look at it as well and give you our 2 cents worth. And even though it's something that we may not be able to manage, it's kind of a value-added service to be able to help those people with their 401ks.
Right. So for many people, they do not even know how to get the statement. So is it something they should go to their employer and ask them, I need, like the second quarter just ended, so should they be able to get a statement from their employer?
Yes, absolutely. Oftentimes you can get a statement online, and if not, you should definitely be asking your employer, for a recent statement.
Right, and as soon as they have the statement for the second quarter, they can bring it to us.
That's correct.
Okay.
Hey Troy, this is Chris. How you doing?
I'm good.
Yeah, I got a question. A few years ago, emerging markets were all the rage in the financial industry. I'm just wondering, what do you think about them today in 2014 and in the future? Is this something maybe for people with, 15 to 20 years before retirement should still look into, or is it something you'd like us to avoid? Or?
Yeah, that's a great question. In fact, I love how you posed it because they were all the rage, and anything that's all the rage is something you never want to necessarily always be in, right? Uh-huh. Because, it could be jeans. Chris, in my day, Guess jeans were hot. I don't even know if they are anymore. I'm not even sure. I think my sister wore Jordache. I don't even know if that brand's still around. So anything that's all the rage, I would probably say to tread lightly in, whether that be Tesla stock or emerging markets. As I mentioned earlier, we've seen a slowdown in emerging markets, and I think that slowdown is because the world powers that be are basically printing money to get out of the financial crisis that they were in, and since that has slowed our tapering of our buybacks, there is becoming a little bit less liquidity in the market. And whenever there's a lot of liquidity in the market, the emerging markets will always do well because the dollars, the United States dollars and the euro and things like that will find their way into those emerging markets. As that begins to slow at some point, in my opinion, the emerging markets tend to slow as well. And I think that's what's happened here over the last probably year and a half to 2 years. So at one point, for instance, Turkey, the country was very hot. Well, it's not right now. In fact, their stock market has done just the opposite. You could probably even throw China into that mix and say that yes, although China maybe is showing some growth, their growth is quite a bit less. So.
Mm-hmm. So on that note, is there any particular place that you might be more optimistic in? Because when you say emerging markets, it could be anywhere, many different countries.
Yeah,
is there
right.
a particular region that's better or worse than others, I guess?
Well, I still believe that South America actually offers a lot of opportunities.
Oh.
I also believe there's certain currencies. There's ways that you can play emerging markets, and we do here with some of the portfolios that we manage, whether it be through currencies or having a small stake in some of those emerging markets is the way to play it. I definitely wouldn't take a huge stake in emerging markets because that can turn against you. But again, a well-balanced portfolio, and obviously, taking a look at your portfolio to see if you have some of that emerging market exposure, because sometimes clients have that within maybe a fund that they own and they just don't know it, and so that maybe that's another good reason, frankly, to come in and have their portfolio reviewed.
Gotcha.
Okay.
Piggybacking on that, there was so much press about energy, and I've also heard about what are they called, master limited partnerships.
Sure.
Are those a good thing, bad thing, mediocre?
Some are good,
bad?
some are bad. I mean, I'm sure Paul can tell you years ago a lot of limited partnerships were sold, and some of them were not very good, and they were sold as tax shelters and this and that, whatever, and all they did was create a bigger tax bill from your preparer because quite frankly they're difficult to assess the gains and get into your tax return. In terms of energy, I think energy is always a good area to be in, and it's an area that we believe, we still need to be in. I do think that there's, from a technology standpoint, and if we do have a big growth in technology, it may just come out of the energy sector. It may not be the next Google Glass, sunglasses. It may very well be something in the energy sector that, whether it be hydrogen-powered vehicles, which, as you may have heard of, or something of that nature. The master limited partnerships, there are some good ones, like the Kinder Morgans and things like that. I mean, there's some decent ones there, but the problem is that there's some bad ones too, and you have to know their structure as well. Because although some of them may be paying out a dividend of 8-9%, oftentimes that can't be replicated in years to come because of the production of that master limited partnership. Okay, I know that's probably a vague answer, but it is somewhat difficult. Okay.
Mm-hmm. Are they included in the Archer funds?
No, we do not have any MLPs. because from a tax perspective, it doesn't always make sense to have an MLP in certain kinds of investment accounts. It'd be particular to each individual situation.
Okay.
Yeah. Okay. Anybody else have any questions?
Yeah, I was looking at how some of the funds were doing for the first 6 months this morning. I noticed this Archer stock fund's doing pretty well. I believe it's at an all-time high at about $42 a share. I was just kind of wondering about this fund itself. You know, it's some of the stocks in the fund are not the ones you hear of every day, like General Electric or FedEx or Pepsi, Coke. They're smaller stocks. Can you talk about maybe what certain of these stocks are and why you chose them and why you all think they have a higher potential for growth than some of the bigger stocks?
Yeah. Well, one of the things that we do in the stock fund, which I think is really interesting, is we use not only a quantitative approach but qualitative approach to picking stocks. And as what we do in the stock fund, and I think it's helped us to outperform, quite frankly, is about 18 months ago we fine-tuned our stock selection process, and we only select 50 stocks in that fund, not 51, 50. So if there's something that we like, we really have to like it to be able to bring it back in. And oftentimes the stocks that we select in the stock fund, again, as I said, we're looking at the balance sheet of those entities, and oftentimes many of those positions that we have of those 50 stocks have absolutely zero debt. They're growing at a great pace, and quite frankly, they're selling below reversion to the mean. So what that means is that they're selling over the last 5 years, their average price earnings multiple, they are trading at a lower amount than the average that they have normally traded at over the last 5 years. Oftentimes, many of those companies are buying back stock as well. So yeah, you're right. Some of the stocks in the stock fund, people have probably never heard of, like Gentex or Lear. Those are both associated with automotive and the aerospace industry. But for instance, Gentex makes rear view mirrors for vehicles. Vehicles today are becoming much more electrical. Back when I was younger, I used to be able to. In fact, one of the cars I had in the 90s, my alternator went out. Well, I used to replace my alternator myself all the time. If you open the hood to your car now, in fact, I just bought my first hybrid vehicle. Actually, I am now driving a hybrid vehicle, and I'm getting about 44 miles to the gallon. Amazing. I opened the hood the other day. I have no idea what's in there. I mean, there are so many electrical components, and a company called Lear, L-E-A-R, is one of our holdings, and they do mainly electrical componentry and wiring in the vehicles today. Well, the vehicles are becoming more and more electrical. So it's been very positive for them, and I think it'll continue to be positive, especially with the onslaught of hybrid vehicles and that sort of thing. So those are the kind of companies that we're looking for. We're looking for companies that are breaking out with new ways of doing things, or bringing new markets to product, or new products to market. And so obviously they're not always the stocks that you hear of. Although in the stock fund there are some companies that we continue to own that we do feel are very good, like Visa, and which almost everyone knows who that is. So. Any other questions? Those are all good questions. Let me just check one time here online. It still looks like there's still quite a few people online. If you have any questions, feel free to write them in. Obviously, this event doesn't go on forever, but if you do have any questions or follow-up questions, or you would like to discuss something, you're more than welcome to get with one of the Sullivan team members and we'd be more than happy to help you out with any of those questions that you may have. And I'd be more than happy to get on the phone and talk to any of the Sullivan clients in over the next several months or years or whatever. So, Paul?
All righty. Thank you for coming. That's the conclusion of this call. You're welcome to email your questions to myself or Kathy, and we can follow up with you.
Okay. Thank you very much for having me, and I wish you all well in investing. So, okay?
Thanks,
Thank
Troy.
you.
Thanks a lot. Bye-bye.
Bye.
Bye.